Trump signs Genius Act, major cryptocurrency legislation passes in Congress. Imagine a world where cryptocurrency finally gets the official nod from the highest levels of government. That's exactly what happened when President Trump put pen to paper on the Genius Act last Friday. This landmark move isn't just about updating old rules, it's a bold step toward legitimizing an industry that's been as unpredictable as a rollercoaster ride, and it's got everyone from tech enthusiasts to financial skeptics buzzing with anticipation. But before we dive deeper, let's set the stage. This bill focuses on creating a solid regulatory framework for payment stablecoins, those digital currencies designed to keep their value steady, unlike the wild swings you see with something like Bitcoin. Now, the path to this law wasn't smooth sailing. It all kicked off after a chaotic week in the House of Representatives, where different factions within the GOP clashed fiercely over a set of crypto-related bills. This infighting brought the entire House floor to a grinding halt, leading to what became the longest vote session on record. Talk about drama. It wasn't until late Wednesday night that Republican leaders managed to broker a deal, thawing things out and paving the way for votes to happen the next day. In the end, the Genius Act sailed through with a strong 308 to 122 vote, thanks to a surprising alliance of most Republicans and a chunk of Democrats, 102 of them, to be precise, showing just how bipartisan this issue has become. To help you wrap your head around what this all means, especially if you're new to the crypto scene, let's break down 5 key aspects of this new stablecoin law. We'll keep it straightforward, adding a bit more context so you can see the bigger picture. First off, this act is like a giant stamp of approval for the entire crypto world. Think of it as the government saying, "Hey, we are taking this seriously." Rob Nolan, a partner at the law firm Duane Morris, who's deep into digital assets and blockchain, puts it this way: it's the inaugural effort by the US to really get a handle on regulating cryptocurrency. By being the first major digital asset bill to make it through Congress and get signed, it adds a layer of credibility that the industry has been craving. Ian Katz, managing partner at Capital Alpha, compares it to a good housekeeping seal of approval, that trusted badge that says something's reliable. This legislation isn't just acknowledging crypto, it's potentially encouraging its growth, which could be the catalyst many innovators need to push forward. But here's where it gets controversial. Not everyone sees this as purely positive. Some critics argue that by giving crypto this boost, the government might be overlooking potential risks, like increased volatility or misuse. And this is the part most people miss. While it legitimizes the industry, it doesn't automatically make it foolproof. Just last year, the crypto landscape looked pretty grim after the FTX collapse and the fraud conviction of its founder, Sam Bankman-Fried, who ended up with a 25-year prison sentence. Under the Biden administration, things were even tougher, with SEC Chair Gary Gensler cracking down hard through enforcement actions rather than clear guidelines. Fast forward to Trump's second term, and it's a complete turnaround. He's embraced crypto by appointing folks like David Sachs as AI and crypto advisor, hosting industry bigwigs at the White House, and even issuing orders to build a Bitcoin reserve. This shift highlights how quickly politics can change the game, but it also raises questions about whether this enthusiasm could lead to overhyped expectations or regulatory gaps. Moving on, while the Genius Act is a win, it's really just the tip of the iceberg when it comes to regulating the broader crypto universe. Stablecoins are only a slice of the pie. They are cryptocurrencies pegged to stable assets like the US dollar to avoid those stomach-churning price swings, making them ideal for everyday transactions. For example, think of stablecoins like USDC or Tether, which maintain a 1-to-1 ratio with the dollar, providing reliability in an otherwise volatile market. But as Rob Nolan points out, this law is merely a starting point. It doesn't cover the full spectrum of digital assets. The big challenge ahead is figuring out how to divide oversight between agencies like the SEC and the Commodity Futures Trading Commission. Last week, the House passed another bill called the Digital Asset Market Clarity Act, aimed at clarifying these rules, but the Senate is lagging behind with its own draft still in the works. Originally, there was talk of getting both stablecoin and market structure laws done before the August recess, but now the target is pushing it to September. This delay underscores the complexity of crypto regulation. It's not just about passing one bill, it's about building a cohesive system that can adapt to fast-changing technology. And this is the part most people miss. Without a comprehensive framework, we might see patchwork rules that could either stifle innovation or leave too many loopholes open. Next, the Genius Act shakes up the roles of various financial watchdogs. Under this new law, agencies like the Office of the Comptroller of the Currency, OCC, will oversee standalone stablecoin issuers, while groups such as the Federal Reserve, FDIC, and National Credit Union Administration step in for institutions they are already monitoring that decide to issue stablecoins. To make this clearer for beginners, imagine the OCC as the gatekeeper for new stablecoin companies, ensuring they meet certain standards before launching. There's even a shortcut. If a stablecoin issuer becomes a chartered bank with the OCC, they might speed through the approval process. That's already happening with companies like Circle and Ripple, who are applying for these licenses to legitimize their operations. But while this sounds efficient, it could complicate things by blurring the lines between traditional banking and crypto, a move that's not without its critics. Speaking of critics, the banking industry isn't sitting idly by and is voicing some serious pushback, especially regarding the idea of stablecoin issuers getting bank charters. In a recent letter to the OCC, major banking groups raised red flags, questioning whether these issuers are truly operating like national trust banks, and urging the agency to put any applications on hold. They argue that this could have wide-ranging effects on the entire banking system, potentially introducing risks that haven't been fully vetted. But here's where it gets controversial. Is this resistance just about protecting established players, or is it a legitimate concern about financial stability? Some might see it as the old guard trying to maintain control, while others worry about the implications for consumers if unregulated elements creep in. This tension highlights a classic debate in finance: innovation versus caution. Finally, even with all this opposition, traditional financial giants are starting to dip their toes into the stablecoin waters. For instance, Bank of America's CEO Brian Moynihan recently announced plans to develop a stablecoin, and Citigroup's Jane Fraser is exploring similar options. Meanwhile, JP Morgan Chase has already rolled out something called JPMD, a deposit token that's akin to a stablecoin, with CEO Jamie Dimon confirming their involvement. Ian Katz suggests that these big players aren't about to let newcomers dominate this potentially lucrative market. They are moving in defensively to ensure they don't get left behind if stablecoins explode in popularity. To put this in perspective, consider how digital payments are evolving. Stablecoins could revolutionize cross-border transactions by making them faster and cheaper, but they also carry risks like counterparty exposure. And this is the part most people miss. While the hype is real, adoption might not happen overnight, and these traditional firms are hedging their bets accordingly. As we wrap this up, it's clear that the Genius Act is more than just a law, it's a signal of changing times in finance. But let's not shy away from the debate. Could this push for crypto regulation spark a boom in innovation, or does it risk amplifying existing vulnerabilities, like the ones exposed in the FTX saga? What do you think? Are you excited about this new era, or do you see potential pitfalls? Share your thoughts in the comments. I'd love to hear whether you agree or have a different take on how this could play out. Crypto's historic win: Genius Act passes in the US. A historic week for cryptocurrency in America. In a groundbreaking moment for the cryptocurrency landscape, President Trump proudly showcased the Genius Act, the first significant piece of legislation regarding crypto to be passed by Congress, during a signing ceremony at the White House in Washington, D.C., on July 18, 2025. This event marks a pivotal shift in the U.S. government's approach to digital currencies, which had previously been viewed with skepticism and caution. For many years, the US government maintained a hands-off stance towards cryptocurrencies, labeling them as too perilous for the average citizen and too volatile for the stability of the financial system. However, this perspective has dramatically changed. Earlier this week, Congress made history by voting in favor of the first major cryptocurrency legislation, indicating a significant transformation in the US attitude towards these digital assets. Following this vote, the total market capitalization of cryptocurrencies soared to an unprecedented $4 trillion, reflecting the enthusiasm and optimism permeating the sector. During a celebratory ceremony on Friday, President Trump, who has expressed his ambition to establish America as the crypto capital of the world, officially enacted the bill into law amidst applause from Republican lawmakers. Today, we take a monumental step to solidify American leadership in global finance and cryptocurrency technology with the signing of the landmark Genius Act, Trump declared. This new legislation introduces regulations specifically targeting a promising segment of the crypto market known as stablecoins. It also lays the groundwork for additional legislation, as 2 other crypto-related bills are currently progressing through Congress. Among these, the Clarity Act stands out as a priority for the cryptocurrency community. Passed by the House on Thursday, as part of what Republican lawmakers have dubbed Crypto Week, this bill aims to transfer regulatory authority over the crypto sector to a smaller agency known as the Commodity Futures Trading Commission (CFTC). This proposed change could significantly alter the regulatory landscape for digital currencies in the US, raising concerns among critics who fear it may lead to insufficient oversight of what they perceive as a risky segment of the financial market. The bill is now headed to the Senate, where its future remains uncertain, and opponents of the legislation are prepared to mount a vigorous defense against it. For advocates of cryptocurrency, this week has been a cause for celebration. Proponents have long held the belief that digital currencies represent the future of financial transactions. While they acknowledge the existence of less reputable aspects of the sector, such as meme coins that capitalize on internet fads, they assert that cryptocurrencies can deliver genuine value. Stablecoins serve as a prime example of this potential. These digital currencies are considered safer because each stablecoin is required to be backed by a reserve of traditional currency, such as dollars or euros. This means that if you purchase $1 worth of stablecoin, the issuing company must hold $1 in reserve. Companies involved in stablecoins see immense opportunities ahead. Since stablecoins are pegged to traditional currencies, they are effectively treated as cash equivalents. Industry leaders believe that stablecoins will enable individuals and businesses to transfer funds globally in real time, bypassing the high fees typically associated with banks and money transfer services. For instance, a company receiving $100 in stablecoins can easily convert that into $100 in actual dollars, thanks to the backing of the stablecoin. Many in the industry view this capability as revolutionary. Kevin Letterniety, CEO of Borderless.xyz, a firm specializing in stablecoin transactions, predicts, in the next 10 to 20 years, stablecoins will likely become the standard for commerce. However, not everyone shares this optimistic outlook. Critics are wary of the implications of the Genius Act. While the legislation does include some protective measures, such as requiring stablecoin companies to maintain adequate reserves and ensuring transparency regarding their holdings, detractors argue that these regulations are insufficient. They contend that the crypto industry has exerted considerable influence over the legislation through extensive lobbying and substantial campaign contributions. Last year alone, the crypto sector invested over $100 million in congressional races and is amassing an even larger war chest for the upcoming midterms. Amanda Fisher, Policy Director and COO of the consumer advocacy group Better Markets, expressed skepticism, stating, "It's all hype, and there's not much substance." While there are certainly issues within the current payment system, this bill does not address them. In fact, it may exacerbate many existing problems. Critics warn that without adequate safeguards, the widespread adoption of stablecoins could ultimately harm consumers and the economy. Nevertheless, the stablecoin industry staunchly defends the regulations established by the Genius Act, which received significant bipartisan support. Dante Despart, Chief Strategy Officer for Circle, a major stablecoin issuer, emphasized, "The law sets a clear standard that even large banks must follow if they issue payments in stablecoins." The fact that 102 Democrats voted alongside their Republican colleagues for the Genius Act indicates that it meets essential consumer protection criteria. I believe this bill represents the most significant financial regulation we have seen in decades, if not in American history, in terms of promoting a pro-growth, pro-competition, and pro-consumer agenda. Despite the criticisms, the cryptocurrency sector remains optimistic, buoyed by substantial financial resources and the backing of President Trump. The Trump family has controversially engaged in the crypto space, with investments in World Liberty Financial, a company exploring various facets of the industry, including the launch of its own stablecoin. Looking ahead, the Clarity Act is now the next major objective for the crypto community. This bill seeks to diminish the regulatory authority of the Securities and Exchange Commission (SEC), which has been perceived as a stringent overseer of Wall Street, but has often clashed with the crypto sector during the Biden administration. Under the leadership of former Chairman Gary Gensler, the SEC aggressively pursued regulatory actions against the crypto industry, including aiding in the conviction of former FTX CEO Sam Bankman-Fried, who received a prison sentence exceeding 20 years. The Biden administration's goal was to compel crypto companies to adhere to the same regulations that govern traditional financial institutions. However, crypto advocates argue that digital currencies represent a novel and innovative financial product that necessitates a distinct regulatory framework, one that critics suggest the crypto sector is attempting to shape to its advantage through significant electoral spending. Mark Hayes, Associate Director for Cryptocurrency and Financial Technology at Americans for Financial Reform, cautioned people could find themselves in a precarious situation, inundated with new products that come with less oversight and increased risk. "We are conducting an uncontrolled experiment on our financial system using a technology that has yet to fulfill its promises." For the time being, however, the cryptocurrency industry is celebrating a significant victory with the successful passage of the Genius Act, and it continues to push forward. Stablecoin bill passed. What's next for banks and financial markets? The stablecoin bill has now passed law, marking a pivotal shift in how banks operate within the financial landscape. As President Donald Trump signed it into effect, https://www.americanbanker.com/Trump-signs-stablecoin-bill-into-law, banks are preparing to engage regulators to either further challenge or safeguard their traditional banking operations. This legislation presents both challenges and opportunities for institutions, particularly those aiming to provide banking services or launch their own stablecoins. Experts argue that the bill introduces a robust regulatory framework, which may reduce uncertainty for non-bank entities seeking to issue stablecoins. However, many banks lack the full scope of provisions in the bill, such as restrictions on receiving Federal Reserve master accounts or preventing yield-based products. Small banks fear that widespread adoption of stablecoins could disrupt traditional banking functions, potentially disintermediating the system. Now that the bill is law, much of this discussion will turn to regulatory actions, as agencies must craft a comprehensive set of rules to address the evolving market. The most critical task for regulators is defining how non-bank issuers can interact with stablecoins, an area where the bill provided significant flexibility between the Treasury Department and state authorities. Key concerns from industry leaders include whether banks holding companies or insurance entities would engage in stablecoin activities, and whether the marketplace will evolve in terms of who controls it. Additionally, the Federal Reserve plays a central role in setting guidelines for non-bank payment stablecoins, with its policy statement offering varying interpretations of access to master accounts. Banks interested in the stablecoin sector also face legal considerations regarding the structure of their offerings, including corporate governance and ownership arrangements. A notable issue remains related to yield mechanisms, which could influence regulatory decisions by individual policymakers, states, or the Treasury. While the Genius Act passed relatively quickly in Congress, there is a possibility that the market structure legislation will take longer due to the complexity of reconciling differing provisions. The Senate Banking Committee Chair, Tim Scott, has released a draft of a new market structure bill, suggesting that potential legislative action may come from the House instead. In this dynamic environment, banks and non-bank entities remain actively building solutions as the rules continue to develop.